Hello. Welcome to Ramirez Crypto News, where we bring you all information and updates about cryptocurrency. Today, we will looking into stable coins, its controversies and potential risk. Stable coins are a type of cryptocurrency that seeks to maintain a stable value relative to a particular asset or basket of assets. Despite their benefits, stable coins have faced criticism and controversy regarding their stability and potential for misuse. Stable coins have undergone significant evolution over the last few years, with various models and approaches emerging. First-generation stable coins were centralized and collateralized currencies, that is, pegged to a fiat currency or a commodity like gold. These include Tether, USDT, and True USD, TUSD. Tether, in particular, has been embroiled in controversy, with allegations of lack of transparency and insufficient fiat backing. Second-generation stable coins are collateralized by cryptocurrencies. The most well-known example is MakerDAO, DAI, which is backed by Ethereum and governed by a system of smart contracts. The MakerDAO system involves creating and managing a collateralized debt position, CDP, to create DAI, with the resulting stability depending on the health of the Ethereum system. Third-generation stable coins are non-collateralized and algorithmically stabilized, with stability achieved through adjustments to supply and demand. These include Ampleforth, AMPL, and Empty Set Dollar, ESD. Ampleforth adjusts supply based on market demand, with the aim of keeping its price stable. ESD, on the other hand, is designed to be deflationary, with the supply decreasing as demand increases, and the value stabilized through a governance system based on voting. Stable coins has some relative advantages, which includes 1. Stability. Stable coins are designed to maintain their value through a stable monetary peg, typically against a fiat currency such as the US dollar. This means that cryptocurrencies can be used as a medium of exchange without the volatility associated with traditional cryptocurrencies such as Bitcoin. 2. Decentralization. Stable coins are typically decentralized, meaning they are not controlled by a central authority or entity. This allows users to make transactions and store value without relying on a central party. 3. Fast transactions. Stable coins can be used to facilitate fast, low-cost transactions across borders without the need for a traditional intermediary such as a bank. This makes them ideal for use in decentralized finance, DeFi, applications. 4. Transparency. Many stable coin projects are built on open-source blockchain systems, making them transparent and auditable. This ensures that users can see the underlying assets or collateral that back the stable coin. 5. Accessibility. Stable coins allow users to access the cryptocurrency market without being exposed to the volatility of traditional cryptocurrencies. This makes them accessible to a broader range of individuals, including those who are not comfortable with the volatility of Bitcoin. There are so many controversies associated with stable coins. Some are 1. Lack of regulation. One of the primary concerns surrounding stable coins is the lack of regulation. Unlike traditional fiat currencies, stable coins are not backed by a central authority and are not subject to government regulation. This lack of regulation raises concerns about the stability and security of stable coins. 2. Counterparty risk. Another potential risk of stable coins is the risk of counterparty default. Stable coins are typically issued by private companies, which means that the stability of the coin is dependent on the financial health and credibility of the issuer. If the issuer were to default or go bankrupt, the value of the stable coin could plummet, leading to significant losses for investors. 3. Market dependency. Stable coins are heavily dependent on the market demand for the asset they are pegged to. If there is a sudden shift in market demand, the stability of the coin could be compromised, leading to price fluctuations and even potential loss of value. 4. Volatility. Despite being called stable coins, they can experience volatility. This is usually common when there is a sudden reversal of investments. 5. Lack of transparency. Most stable coins are centralized. This means the issuer has complete control over the coin. The lack of transparency and clear communication from the issuer could create trust issues amongst investors. Stable coins have the potential to provide stability to the volatile cryptocurrency market. However, it is important for investors to approach stable coins with caution and conduct their due diligence before investing. Stable coins are a relatively new form of cryptocurrency that aim to provide stability and security for investors by pegging their value to existing currencies or assets. While the idea of stable coins has gained traction with both individuals and institutional investors, there are a number of potential risks associated with these cryptocurrencies that should be considered. Some of these risks are: 1. Lack of transparency. One of the key risks associated with stable coins is the lack of transparency around their backing. Many stable coins are backed by fiat currencies or other assets, but it can be difficult to determine exactly what these assets are or how they are being guarded. 2. Volatile market conditions. Although stable coins are designed to stay stable in value, changes in market conditions could impact their stability. For example, if a stable coin is pegged to the US dollar, but the dollar loses value due to inflation or some other economic condition, then the stable coin's value may also drop. 3. Centralized control. Many stable coins are controlled by a small group of individuals or a single entity. This can lead to concerns about centralized control, manipulation, and regulation. If the entity that controls the stable coin runs into financial trouble for some reason, it could lead to a significant drop in the value of the coin. 4. Security risks. Like any cryptocurrency, stable coins are only as secure as the technology that underlies them. If there are vulnerabilities in the code or security protocols, then investors could be at risk of theft or other security breaches. 5. Regulatory concerns. Stable coins are still in a relatively new and unregulated space, which means that there are regulatory risks associated with investing in them. While the potential risks of stable coins should not be overlooked, it's important to note that these cryptocurrencies can also provide a number of benefits for investors. As with any investment, individuals should carefully weigh both the risks and the potential rewards before deciding whether to invest in stable coins or any other cryptocurrency.